So this is how I would construct a basic market-focused portfolio. Keep in mind, this isn't financial advice, just an opinion. So first of all, I would allocate about 40 to 50% of your portfolio to VTI. It's a Vanguard ETF that provides broad market exposure. There's about 3,500 different stocks in this portfolio, so it is very broad in nature. That said, there's a lot of weight focused on some of the larger companies in the market. So you're getting that weighted exposure into some of the biggest companies in the United States while also getting a broad range of exposure across thousands of different companies. VTI also has an incredibly low expense ratio. I think it's 0.03%, so it's a cheap way to have broad market exposure. Next, I think it's important to have exposure to global markets, global equity markets. VXUS, another Vanguard fund, gives exposure to just that. It allows you to have exposure to both emerging and developed economies. Again, has a very low expense ratio and does, as described, provides broad spectrum exposure to a large number of foreign companies, foreign equities. I would allocate about 20% of my portfolio to VXUS, and depending on how bullish or bearish you are on foreign markets generally, you can kind of adjust that position up or down, but I would target right around 20%. Next, you want to have exposure to small cap companies here in the United States. Now, the problem with this is a lot of small cap ETFs fail to capture decent returns because so many small cap companies fail or are just generally unstable, bad businesses. And obviously, you don't want exposure to these companies. Having some kind of active management is important in a small cap ETF or mutual fund to ensure that the bulk of your portfolio isn't allocated towards bad businesses. For that reason, I recommend AVUV or DFSV for your small cap allocation. These ETFs both provide broad market small cap exposure. However, they're both actively managed. And I think when it comes to a small cap fund, active management is actually quite important. A lot of the companies that make up the small cap universe in the stock market are, for lack of a better word, bad companies. They're unprofitable, they're stagnant, they're shrinking, they're just not great businesses. Whereas exposure to larger companies like the S&P 500, for example, gives you exposure to primarily large, established, growing companies. Whereas small cap funds can often be businesses that are failing, not doing well, or actually on the brink of bankruptcy. And so having some active management to weed out those businesses and maintain focus on good, stable, strong performing assets, I think is paramount. You're going to pay for that. These ETFs have slightly higher expense ratios. I think they go as high as 0.3%. However, I think that's very much worth it in the pursuit of ensuring that you do not have exposure to bad businesses. You're going to want to allocate about 20% of your portfolio to these ETFs as well. You could split that 20%, 10 and 10 between the two, or pick your poison. Either one will work just fine, in my opinion. Both have some benefits in the long term, but I think at an aggregate, they'll probably perform at roughly the same level over the next several years. Finally, you're going to want to have about 10% of your portfolio in some kind of cash position. I believe the best way to go about this is by investing into treasuries, specifically inflation-protected treasuries. You can do so by investing directly into the underlying inflation-protected treasuries, or you can simply participate in an ETF. There's VTIP, the Vanguard fund, and then the iShares fund is STIP. These basically perform the exact same way. They're interchangeable. You can use either one in your portfolio, depending on your preference. But the point here is to protect you from inflation while also maintaining a cash position, which you can deploy into the market should there be any kind of dip. It also gives you a non-correlated asset to protect against large changes in market volatility, or more specifically, a drop in the value of the market. And so in aggregate, you're going to have roughly half of your portfolio in a broad market ETF like VTI. You're going to have about 20% of your portfolio in a small cap fund and about 20% of your portfolio in foreign equities. Finally, with about 10% in some kind of cash fund. Like I said, I think a treasury, inflation-protected treasury is the best way to go about that. This portfolio overall gives you really strong exposure to the equity markets here in the United States without over-concentration in a handful of the largest companies, while also giving you some exposure to the broader equity markets outside of the US and some protection against the downside and an opportunity to invest into that downside should it come. Your risk-adjusted return in a portfolio like this is a lot stronger than having everything in the S&P 500. as it prevents any kind of overconcentration while still giving you strong exposure to overall equities, domestic and abroad. Now, I think the biggest probably point of contention within this portfolio is the foreign ETF exposure. While I think most people would agree that having foreign exposure is a good idea for the sake of diversification, that particular ETF has not performed super well in comparison to, say, like the S&P 500 over the last several years. That said, I think some of the same arguments that we made for small cap ETFs can be made for foreign ETFs, and that active management can be extremely beneficial. The problem that I've found is that a lot of the best performing mutual funds and ETFs in the foreign equity space have either large expense ratios or front-end loads their mutual funds. The problem with that, of course, is that your total returns decrease substantially as a result of the fees that you're being charged, and I think it end up putting you in a position where you're generating returns similar to a simple broad market ETF. For example, American Funds has a mutual fund, ticker is NEWFX, I believe. That's performed really well, but they have something like a 5% front-end load and then an ongoing 1% expense ratio. So the cost of owning this fund is so high that it eats up a lot of the returns. And I think for that reason, it just makes sense to go into a broad market ETF with a lower expense ratio. That said, there are a lot of better performing mutual funds and ETFs out there that have more active management to weed out some bad companies in the foreign equity space. I think it's a bit of a crapshoot. Honestly, if you end up allocating more of your portfolio towards American-based companies, putting a larger weight towards VTI, for example, I don't think you're hurting yourself doing so. You're just lacking broader diversification outside of the U.S. You're very concentrated in the U.S. economy's performance. Obviously, I'm very bullish on the U.S. I think the U.S. will do just fine. So doing so is not necessarily bad. I wanted to make this video to give folks some options to allocate their portfolio in a little bit more diversified manner, rather than having the bulk of their portfolio in the S&P 500 and the largest handful of companies in the United States. I think having some exposure to foreign companies, some exposure to smaller companies here in the U.S. gives you more diversification, potentially some protection against downside risk, while still giving you really solid upside performance over the long term. Again, this isn't financial advice, but hopefully this helps. Thanks.